Let me touch on our top three things. Number one, China. Shanghai Composite's up another 2.4% this morning to 36% year to date, which is outstanding. It's actually even more outstanding. It's actually up 92% since growth and inflation really started to slow sort of late last year. Definitely the expectation for supportive policy on the margin continues to perpetuate a stock market bubble in China that we definitely think has legs as it relates to our expectations for slowing Chinese GDP growth and inflation. Number two, the US dollar. It's backing off again this morning, and it continues to price in what we think is a lower for longer thesis, at lower for longer, i.e. on interest rates, particularly short-term rates. Both Keith's FX and Treasury yield immediate term risk ranges are tightening, which implies less short-term volatility in both of these two big macro asset classes, particularly if the Fed delivers dovish next Wednesday at their FOMC statement, which we expect them to do. And then lastly, in housing, we'll see where the bears live today and tomorrow as we get more housing data. We get the existing home sales and new home sales reports over the next 2 days. But ITB remains one of our favorite sectors, or on the long side within the U.S. equity market. It was actually up 1.4% in a down tape, and the subsector's up 8.6% year to date, which is obviously far outpacing any gains in the broader equity market. And so with that, we'll just wrap it up with Keith's immediate term risk ranges for the S&P 500, which is 2082 to 2112, and for the U.S. Treasury yield, which is 1.85 to 1.95%.